Hi everyone, hope you're all doing well. Today I'm going to talk about how to get 100% return on a stock. So you guys know whenever I buy a stock, I buy it for a 100% return and I try to get it over a 5-year period. So I'm going to create a bit of a checklist with you today that I personally use, that I would look into a stock, and if it ticked a lot of these boxes, I would potentially go buy. So hopefully whenever you go buy a stock, you can use this checklist to maybe see if it's a good stock or a good investment to be making. I thought I'd share a little bit more of a detailed point of view of how I research a business now. And obviously you guys know that have been watching the channel for a long time, I have a pretty good record of getting 100% return stocks into my portfolio. So this could be something a little bit useful you use going forward about researching for your stocks. Now hopefully this video is useful, and if you do want to see more exclusive content like this from me, you can join the Patreon. We do an education video series on there, and that's where members of the Discord can vote for me to talk about something like this, like how to look at revenue, profitability, share buybacks and everything like that. So I hope you check that out if you do find this video a little bit helpful. But here we go, how to get 100% return on a stock. So first of all, I've got my 3 key points on the right that is a must, and the rest is kind of like equal points, so there's not any particular order they're going in. So first of all, the big one, this one here, revenue and profit growth. Whenever I buy a business, it's got to have revenue growth, it's got to have profit growth. At the end of the day, how is your business going to be valued more in the next 5 years? If you have a business that does 100 million in revenue and you do 200 million in revenue in 5 years time, if you've got a business that's doing 10 million in profitability and it does 20 million in profitability in 5 years time, more than likely is that business going to be worth less or more? It's going to be worth more. So this is the key thing that drives all successful businesses, is the revenue growth and profit growth. Now there is certain situations where it's how much do you pay up for that profit growth, how much do you pay up that revenue growth, and that's where it comes into the valuation side of it. So there's different aspects to there, but the basic understanding is that I want to have a business that has revenue growth and profit growth. That is what's going to drive up value of that business. So that's the key things I'm looking for. Now I've put this joint first. I'll start off with profit growth. Profit growth is key. That is the thing that will generate potentially dividends that you can have, or share buybacks you can have, as well as the profit growth that goes down to the balance sheet. The business has more cash, it's a more healthier business. And that's ultimately what most businesses are going to get judged off, is the amount of profitability they can throw off. Now, there's a point of view where do you buy a company that doesn't have profitability but moves to profitability? And I sometimes do that. Now, that's sometimes where I see new investors start doing that a fair bit. They start going into stocks that are unprofitable, and that's where they get burnt a little bit, because there is that high risk of a business that is unprofitable. Can they actually turn profitability? That's where I always see new investors get burnt by unprofitable stocks, is because they go straight into that end rather than focusing on mature, profitable business first. So that's personally, I would not mind buying an unprofitable business, but I have to see it make profitability in 2 years, because at the end of the day, there's only so long a company can burn the cash for. Eventually it will get judged off its profitability, and ultimately that's what you'll value it off in a mature business cycle. So I will be massively looking at profitability and profitability growth. Now profit can be limited if revenue growth stops. So it's also key to have revenue growth. The more revenue growth you have, the more scale you have, you're probably going to be delivering more profitability. So those are 2 key drivers that you need to have. There's only so long you can generate profitability with no revenue. Sometimes I see that with some businesses. So revenue and profit growth is a must. If you don't have revenue and profit growth, you're not going to have a successful business, in my opinion. So that is ultimately what I'm looking for: a track record of profitable growth and revenue growth, and also future profit and revenue growth. Number 2, the next important thing for me is the balance sheet. After I've looked at business from a revenue and profit point of view, I will look at the balance sheet and the cash and the debt side of it. Balance sheet wise, the big thing I'm looking at is cash. In my opinion, cash is king. That's the most important thing I look for on a company, is the cash pile. Cash pile is key because it covers things like dividends, it covers things like share buybacks, it can pay debt off if needed. If it gets a big charge, a big fine, it can pay it off. Cash is king. Cash is absolutely amazing. If anything is to have for the business, if they have a nice cash pile, it's probably going to solve most of those issues. Companies that have low cash piles, I really don't like touching them, because if something goes wrong out of nowhere, it can sting them massively. Cash, like I said, pay down debt, pay dividends, pay share buybacks. I once saw a business, and it was actually called Sleep Number. And I was never a fan of this business because they had such small cash piles. And in fact, they actually increased the debt to do share buybacks. And I always said, like, if anything was to go wrong, where we're hitting a high interest rate environment and all of a sudden they want to pay down some debts, or if they get a big massive fine, that business is going to get absolutely stung. And it was a really popular one. I think Everything Money was a really big fan of it, and I was like, I won't touch this because of the cash balance and also the debt, to be fair. That's been an ugly performing stock. So cash always solves a lot of issues. A lot of the companies that were panicked during the CV situation were the companies that didn't have a lot of cash, but also what probably a lot of them had was debt. I like having companies that have no debt. If I can, small amounts of debt, because debt is something that always will take an impact on the profitability, and what we've seen at the moment is a high interest rate environment comes around, all of a sudden everyone's going, yeah, that debt's fine, and then it comes taken onto debt at a higher interest rate, it absolutely stings your business. And as well as that, obviously them debt obligations can scale up more and more, cash gets shrunk down, it's not a good place to be. So I like to have companies that have little debt or no debt at all, and a lot of debt, low debt to equity as well. And the third thing is valuation. I try to get it at historic lows or below historic average valuations. That's always what I try to do with a business if I can. There's a couple of times where I will overpay for a business, because ultimately, even if you pay a bad valuation for a business, if the business actually has good amounts of revenue and profit growth, let's say you do overpay for a business and it doesn't really go up as much as what you were hoping for, because you overpaid for it. As long as it still carries on proving, you can overpay for a business and still make money on it, because eventually the financial numbers will catch up to the valuations you pay for. Sometimes people think, oh, I don't want to overpay for a business, but if it's a good business, you can actually sometimes overpay for it, and you might not do that well, but as long as it's growing profit and revenue, you could probably still get away with it. What does help is buying companies at very low valuations, historic valuations, and then they do these numbers. That's normally where you get the good returns from. So valuation I put third, because sometimes you can get away with overpaying for some businesses as long as it's a good business. But valuations can sometimes really help up your returns. An example for this is DraftKings, for example. That's my largest position. I started paying for that business quite high up, around $50. I personally said I would like to buy it at $30, and I looked at $50 and I was like, I don't know if it is going to go to $30, and I really like this business, so I started buying it. We did have the valuation reset, and if I did buy it at $10, where it did eventually go down to, I'd be up absolutely mega, but I just didn't know it was going to go there, and it took me by a big surprise. But what it was able to do is that I was able to average down that position at historic low valuations, and I still had a good average, and I still made money from that. So that's the prime example where even for me that I did actually overpay for business, and I still made money on it. But sometimes buying at them low valuations, then bottom of the historic valuations, those are sometimes where you can get the really big returns. Example of that is Mercado Libre, bought that historical low valuations, and obviously that's done very well when you look at that sort of business. When you look at HIMS, if you look at a price to sales metric, lowest price to sales it's ever been at, obviously that did very well. So there's a few examples I could use like that, for example. Now we're on to the smaller ones. I've got to say, one thing that I did not put on here is small caps. I do buy small caps, but I don't buy micro caps, like really small businesses, just because of the volatility. I didn't put that on here. I won't touch them sort of businesses because of the volatility there. On the US side, I don't normally go that much smaller than a 500 million market cap. On the UK side, I don't normally go much more smaller than 100 million market cap. So I thought I'd put that on there. I've not put it on the whiteboard. But first of all, the next thing is share buybacks. I really like a business that's buying share buybacks. The reason why is because it's probably undervalued and they're taking advantage of that, which I really like. And if they are doing that, that's absolutely amazing. And also, if they're doing share buybacks, it normally probably means that they don't have that many debt obligations to be making, and they probably have a lot of cash, and that's probably because they throw off a lot of profitability as well. So that's a good thing, that the business is probably in a healthy place, but also that I'm owning more of the business. And as well as owning more of the business, because there's less shares outstanding because the business is buying it back, financially as well, it's better for the business. The EPS is going to improve because of that. So I do really like a business that's buying back shares. And that also leads me on to the next one, which is no big stock-based compensation. I don't like companies that do big stock-based compensation. Now, sometimes if I am going for the more lower profit businesses, or those companies that are just swings towards profitability, quite often they could be doing quite a bit of stock-based compensation, because it's better for them for the cash burn side of it. So that's something you have to accept, as long as it's not something crazy. Like if you've got a business that's worth 2 billion and they're doing 200 million of stock-based compensation, it's probably a little bit too much. So I don't like being diluted that much as a shareholder. If there's a company that really dilutes you as a shareholder, I probably won't touch that either. But if it's a little bit, and sometimes they might neutralize it with a share buyback, I'm fine with that. The next thing is insider buying. You don't get it as much on the US stocks, but definitely for the UK stocks, you could get this quite often. Insider buying, I like if the CEO and the CFO or the chairman of the board, if any of those three people in particular are buying a lot of shares, that's really positive to me. The fact that they're, especially if the big buys. Sometimes if the smaller buys, I'm a bit like, it's not that much. But if it's big buys, I'm like, well, if the own CEO, and they've probably got bigger inside than us, if they're willing to put their cash in there, it at least says to me it's probably not looking bad. It might be doing okay, it might be doing amazing, but it's not bad. Because if it was going bad, they would be like, why am I going to put 50k of my own, or whatever it is, money, into a business if they know it's going to go terribly wrong in the next 12 months? They're not. So I do like insider buying. Insider selling, I haven't put on this list. Insider selling doesn't really bother me that much. So yeah, that's something that I'll put on there. Big insider ownership. This used to be a lot bigger for me. I used to like seeing big insider ownership inside the business. Nowadays, I don't actually bother about it that much. Sometimes I think like it could even be a bit of a problem because sometimes maybe they don't feel that much responsibility. Whereas maybe as if there's these big institutions in there, that's actually a sign that the big money is willing to go in there. As well as that, there's a little bit more of a pressure to maybe deliver for the big money that's kind of on the shoulders all the time going, what's going on with this, what's going on with this? So this actually used to be a really big one. Nowadays, I'll be honest with you, I nearly didn't put it on the list. I used to like a really big insider ownership, but now I don't really. I guess the big thing that sometimes I do like is a founder-led business if they've been there for like a long period of time. I do sometimes like a founder business, but there again, I've seen founder-led businesses as well go bankrupt. So yeah, it's sometimes something that doesn't. Yeah, like this used to be really big for me, but it's not as much now. So this, if it was in a tier order, it's probably down here to be fair. Next thing is a moat. Now this is a massively debatable, but I'm looking at this from a point of view where I see it as a moat. Sometimes other people don't see it as a moat, but if I see it as like, oh, that's a good moat. An example is like Starbucks. Like some people would argue Starbucks is a moat, and some people would argue that Starbucks is not a moat because at the end of the day, it just sells coffee. It's quite easy for another company to open up a coffee shop. There's not really a moat around selling coffee. However, you stick a Starbucks into any location, all of a sudden opens up the next day, you've got a queue in your drive-through. So does that mean that the brand itself does have a moat around it? The moats come very debatable. Some people say Starbucks has a moat, some people say Starbucks doesn't have a moat. It's massively debatable, but if I see something there that I see as a moat, then I will like that product. Sometimes I see things as a moat as some people don't see things as a moat. An example for something that I see as a moat and other people don't see is maybe like my largest position, DraftKings. Some people say, oh, it's just a online sports betting business. I'd say, but it's an online sports business that has the biggest market share. It's got the number one player. It's got 30% of the market. It doesn't come that sort of player without a moat. And the reason why it has a moat is because it's got the best app out there. It's got the best features out there. It's got the parlay option. So it's one of those that's really controversial. But if I can see a moat there, then I like that. So yeah, that's one up for debate, which I won't go into too much to today. Next thing is catalyst for growth. So I like looking at things that maybe aren't in the numbers. Especially I get this majorly from conference calls. Like when management teams say things in conference calls, like and that could be a really good thing for our business, but it's not in the guidance, something like that. I like looking at catalysts as well, where there's something that's upcoming that could be a significant driver of growth or revenue growth for the business that maybe is not factored into the business. I like looking at them sort of catalysts where it's something to get excited for, or a new product that's going to get launched, for example. So I like looking at something that maybe the market isn't pricing in, but it could do a really big success for the business. That's what I like looking for. Is there a new brand deal they've launched? Is there a new location they're expanding into? Is there a new product they've got? Is there a new partnership they've got? I like looking at all those little catalysts that may be significant growth drivers that really the market isn't paying up for. Understandable. So I always say this, Peter Lynch, buy what you know. that's something that I sometimes I see people buying some businesses, and I'm like, how do you know what that is? I quite often see people buying like pharma companies, and I'm like, how do you know the moat around that and who uses it and how good it is, or how the FDA are going to approve? Like, there's businesses that I sometimes, semiconductors, mining companies. There's a lot of businesses I look at and I go, how do people value that? Like, the only way you'd value that, in my opinion, is if you're in the industry. And I don't touch anything like that. I always buy something that I understand the industry in, or something that I use myself. That's personally what I do, and I always think that will give you the upper edge as an investor, and that's something that I always do, is buy things you know. Sometimes I think people get a bit carried away. You don't have to own these high-tech businesses. There's simple businesses like Card Factory that's on the high street down the road that are successful businesses, and anyone that's bought Card Factory in the last few years has done really well. It sells cards. You don't have to buy the most extreme businesses to do well in the market in this game. Next thing is no regulation. I don't like buying companies that quite often have regulation slapped on them. That would be straight away to like pharma companies. I don't like something that's external that can affect the businesses. And I try and avoid anything like that. Anything that can be affected out of my control, I don't touch them. That's one of the main reasons why I don't touch something like a pharma business at all. I try and avoid low margin businesses, not on a profitability point of view, because some companies just have low profit margins. If it's a business that's maybe like 1%, 2% profit margins, I probably won't touch it. And this can have a little bit of a leeway, but low gross margins, I don't like buying companies that have like 10, 20% gross margins. If I can, I try buy higher SaaS business. I do like SaaS businesses more than anything. If I can buy them, it doesn't always have to be SaaS businesses, but I try to get higher margin businesses because it's a lot easier to make good amounts of profitability on them. But there again, at the same time, if it's making good amounts of profitability, there's probably going to be competition that comes into it at some point. So yeah, not a major thing, but I do like high margin businesses if I can. I do like SaaS models if I can, but it's not a key thing. A dividend, I do like a dividend every so often, a dividend that's hiked up and shows growth. Same again, it's not a key thing, but it's nice when sometimes you can own a stock for 5 years, and sometimes you have your money tied up, and sometimes you're like, I've had my money tied up in that in 5 years, and I'm not seeing any profit. Do I sell? But if you're receiving a dividend for the next 5 years off that businesses, you might be more, and it's growing as well. You might be more inclined to carry on holding your shares. So that's a nice bonus, having a dividend. It's not always key though, but if it does, if I do have a growing dividend company, I won't mind buying it, to be fair. Next thing, this probably should, if this was in order, this would probably be up there, to be fair, and that's track history. I like buying companies that have good track history. One of the mistakes that I personally made is a few years ago is I bought a couple of companies that didn't have a track history of delivering. So yeah, when I'm buying a business, I like, it's quite easy for a business that, and you see this quite often, is you'll see a business that has a checkered past and then all of a sudden goes, oh yeah, we're going to grow 10% a year, or our profitability is going to go up to these sort of levels, and it's like, well, you haven't done it for the last 5 years, so why are you going to do it now? And sometimes you could jump on board and going, yeah, I believe the management team, and it's like, well, why should you believe them if they've not done it previously? So yeah, this is something, is that if you could try to find a business that has proven that they can deliver, then the more than likely they're probably going to continue to deliver. It's not guaranteed, but it is nice having a business that goes, we've done this before, now this is what we're going to do. I think that's a good thing. So yeah, a track history on a successful business definitely does help, rather than just assuming they are going to be successful. And the last thing is management team. I try and buy a management team that's been there for a few years. Same again, that have done track history of good financials. When you are buying into a relatively newer business, maybe they're not proven. If let's say they're a business like, one of my stocks is Alphawave. I don't really have much knowledge in the semiconductor space, but I looked at the guy that was running the business, and he's previously had 3 semiconductor businesses that he sold for profitability. So that gave me confidence. Well, he's pretty good in this area. That was a key selling point for me. Where sometimes you could get like a CEO that comes into a business and he's from a total different industry, and it's like, well, that doesn't make sense. And then you're thinking, well, can he be successful in business? Them sort of things. I would rather have someone that has proven track history in that sort of industry, I guess. That does help. Management teams make or break your investments as well. That's the key thing. So ultimately, that will probably be the big dictator if your investment's going to go well, is that management team. So you've got to really trust them. You got to listen to the management team and say, is these guys that I could trust my money with or not? Because ultimately, they're the ones that are going to make your business successful or not successful, which is the really tricky thing. You're kind of judging them, aren't you? It's a bit like a job interview when you listen to them for the first time, anyway. So yeah, that's a little bit of a checklist for you guys, and the things that I do look for in a business when I'm looking to buy one. So maybe it's something useful that you can look at when you're looking at a business going forward. Anyway, hope you enjoyed the video, guys. See you in a bit.